Lenders openly admit that they don't consider any of the other actual expenses you will face as a landlord. It doesn't matter to them. They just don't care. Case in point, Christian Batchelor, a mortgage broker who partners with David Green, formerly of BiggerPockets, said this casually on the BiggerPockets podcast a year and a half ago.
Let's start off by just describing what does DSCR stand for and how is it different than conventional underwriting?
DSCR, to answer your question, David, stands for Debt Service Coverage Ratio. It's a bunch of fancy words that don't mean anything unless you understand it. All that means, a ratio is obviously a ratio of two numbers, and that's going to be your rents over your debts. It's an easy way to think about it, right? So if you have a property that rents for $1,000 a month and your mortgage is $750 a month, you have a cash flow positive property, right? And that mortgage has to include your PITI. Now, a lot of people may ask, what about the utilities? What about the maintenance? What about CapEx? All those other things BiggerPockets told me, that's all well and good. You should put that in your calculators, but it is not how they calculate the ratio that qualifies you for the loan. All they care about is your gross rents over your gross liabilities, including principal, interest, taxes, and insurance.
The wildest part? This was said on the podcast that spent years preaching responsible rental analysis. Just think about it. A DSCR lender's entire business model is supposed to be based on rental income covering expenses, but they completely ignore half of the actual expenses. It's absolutely insane, just ludicrous. And this wasn't just one guy. Christian said he works with over 75 DSCR lenders, and they all use the same formula. And in my own research, I saw the same thing over and over again. So let's stress test that qualified loan from earlier and see what's really going on.